Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's founder, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So, with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where they might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. Today, we're going to talk more about the national economy because we're trying to figure out what will happen with home prices. If the economy is growing well, there's a chance that the surge in prices that took place over the last couple of years will not end in a full-blown price bust. But if the economy is weakening, it's tough to see how prices can remain so far above the means of the average home buyer. Remember that even a small surge of demand when nobody wants to sell, like during a pandemic, can start a boom. But for prices to stay high, you have to have a continuous stream of follow-up buyers who are willing to pay those higher prices. So let's look at the national economy. Here's a picture of the economy represented by the growth of jobs, the increase in jobs every month compared to the same month of the previous year. Despite all the hoopla about job additions in September that exceeded all expectations, the actual increase from last year was the same 2% we've been seeing for a while. And the big question remains whether this is the rate of growth we can expect in the next couple of years, which could allow home prices to come to a soft landing, or whether the growth we can expect is actually much lower, which would lead to a much sharper correction in prices. So let's see how job growth is doing in the major economic sectors. In construction, job growth has been just about 2% all this year, despite high interest rates. But this probably won't last because it includes a 5% increase in the construction of office buildings, where vacancy rates are already high. A lot of developers bet that the end of the pandemic would bring a surge of demand for office space, but just the opposite has happened. And once you start these multi-year projects, you have to finish them. I think that's what we're seeing now. In manufacturing, job growth has been under 1%. In finance, it's just about 1%. In retail, it's been very close to zero. Job growth in the big restaurant sector remains high, more than 3%, but it was under 2% in the years before the pandemic. It's likely we're headed back to that lower growth. In healthcare, on the other hand, the growth of jobs has been getting stronger, almost 4%. This would normally be a very good sign, but part of the increase comes from high job gains at nursing homes. Nursing homes were hit hard by the pandemic, but in previous years, they added jobs at less than 1% a year. So all we're seeing now is a restocking, not an area of enduring growth. The situation is similar in the large government sector, which is adding jobs at almost 3%, but where a good chunk of the increase comes at the state level. That growth is 5% right now, and 2% at the local level. But in normal times, growth in all government sectors is less than 1% a year. So here too, we're mainly seeing rehiring. The biggest source of worry for the economy is the slowing of growth in the very large business services sector, which is our best indicator of actual business activity. It's now growing at just 1%, well below its normal level. One reason is the continuing shedding of temporary workers. These are contract workers that businesses hire when demand is good, but that are the first to go when demand slows down. What does all this mean for home prices? First, that the economy isn't growing very fast, maybe just 1% a year. That's not surprising since the US population is growing less than 1% a year. Slow growth isn't necessarily bad, but it means that there's no vast unfilled demand for more housing. We can see that in new home construction, where builders have been laying people off. Sky-high prices should do just the opposite, but home builders are on the front lines and respond to actual demand, not wishful thinking. Second, it means that home prices are poised for an extended slide, maybe even a harsh fall. The timing will vary by market. It may happen a bit later in Florida and the Southeast, but there's no escaping it, and it's already happening. Just look at Austin, where the population continues to grow at a high rate, where jobs are being added at a high rate, where demand for homes should be high, but where the reality of overpriced housing has hit home. Prices rose 50% in 2 years, but dropped 8% in the past 2 months, in the past 12 months. And it's a good bet that more is on the way. If it's happening here, it will happen everywhere. That's it. In this time of uncertainty, when some markets will do well, but many won't, it's important for professionals to stay on top of local economic and real estate pressures. Local Market Monitor provides the data and analysis they need with local market reports and Investors Metro analysis. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.